Here's your stock market review today. And this morning, we got employment numbers. Employment is actually moving higher despite the fact that the Federal Reserve has raised interest rates as much as they have. Mostly, any moves in the interest rate levels have been sort of swallowed by the economy, and this economy looks like it's moving forward. Stock market moved higher. Bond yields moved higher. Let's break down what I'm looking at with the stock market review for today, showing you a couple charts that I think are key to focus on moving forward. I think the bond yields are going to continue to remain lofty, but I also don't believe it's going to necessarily derail the stock market at this point. I've been saying this for a little bit. Let's jump in and I'll show you what I'm looking at. Thanks so much for stopping by the channel. I've actually just launched this channel. It's doing very well, about to hit some milestones. Thank you so much for all the followers, the great comments down below. What I do here, I break down the economy, show how that affects the stock market and then individual stocks on a value investing standpoint. Make sure to check out my website, dhtayloranalysis.com, where you can find the top 50 value investment stocks. Let's take a look at what happened today in the stock market with the stock market review. This is something I do on a regular basis. First off, let's take a look at all the different ETFs. What I do with this, for this particular section here, each of these, this is the Spider Select Sector ETFs. I take the symbols and then I take whatever stocks are in there, but I only do one share. I'm not looking for weighting or anything like that. I want to know what, if you bought one share of each, what would that do? Certainly some companies are bigger than others, but I'm not really looking for that weighting as much. It's something that I kind of steer away from. Nonetheless, the S&P 500, about 5%, just above 5% for your yield. What I do is I take all 500 stocks. What's the next 4 quarters? Add them together, divide that over top of the current price. That gets you your future yield if you bought 500 shares right now, each share of the S&P 500. You're looking at approximately 5% yield. Going straight down, you can see XLK, the technology sector, of course, is always overvalued, whereas there are other sectors, energy sector, 10% yield. That does not necessarily mean that those stocks are going to go higher. It's just your forward earnings compared to today's price is going to get you about that yield. The stocks could go lower simply because of interest rates and things like this. So make sure to kind of weed through and figure out what it is you're looking for inside there. But that gives you a breakdown as to what's going on. Here's today's numbers, what happened today in the stock market. The S&P 500 index, and that's actually the SPY stock, almost 1%, kind of overtaking what was lost yesterday. What happened? Initial claims, continuing claims. These are, to me, these numbers are a lot more important than non-farm payrolls, which only shows up once a month. Now, there's some pluses and minuses to both. Neither is perfect at all. And everybody always, the conspiratorial individuals always come out, well, the government's doing this to us and all that. My take is just be consistent and we'll go with those numbers. That being said, initial claims well below what individuals, economists were looking for. This economy is moving forward. Continuing claims falling continually. But I wanted to kind of encapsulate that. I took away some big spikes to give you kind of a better idea as to what continuing claims looks like. Continuing claims are a little higher than what they have been, but still, on a relative basis, going all the way back to 1990, this economy is still strong. A lot of people are still employed. That green line is sort of the unemployment rate when you look at continuing claims and those who are unemployed versus the population that could be working. So that gives you an idea. And I've been saying this economy is strong. And we keep getting numbers like that. The Federal Reserve has no reason whatsoever to lower interest rates, given the information we keep getting. We just got retail sales yesterday. They were sizzling hot. That's 2 months in a row, 0.6, month over month increase. That's 1.2% increase over the past 2 months in retail sales. This economy is strong. Here we're looking at the federal funds effective rate, not the target rate, but the effective rate, what they actually succeeded getting at. We've certainly had the Fed funds rate at this level before. And if you go backwards, just before the big crash of 2008, 2009, the Federal Reserve needed to raise interest rates there. Prior to that, in the dot-com era, things were just cruising here in the United States and around the world, really pushing the economy the way it did. Before the dot-com bust, all those unicorns, they were mini unicorns back in those days. Nonetheless, we've been at this rate before. This isn't a historically high effective target rate by the Federal Reserve. The economy is certainly moving forward and effectively moving forward at these rates. I don't really necessarily see this interest rate level right now today as being either too restrictive or too accommodative. We may see, because we're seeing employment numbers kind of moving higher, unemployment lower, what we might see is the Federal Reserve start getting a little nervous. Maybe they have to bump interest rates up maybe a quarter point or a half a point and leave them there for a little bit longer. But I am nowhere near sold that interest rates are going to fall 3 times this year. I've been saying that for months, and we're starting to see that information coming forward. That's one sort of, that's the left hand. Now the right hand says this economy is moving forward, and because of that, so will the stock market. Here you can see, I think we finished up about 4.14% for the U.S. 10-year benchmark rate. And it had slid lower over the past couple weeks, all through November, December. But right towards the end of December, the U.S. 10-year Treasury yield bounced and it still looks like it wants to kind of move higher. I expect we could easily see 4.5%. But I don't think we're really going to be racing above 5% given the information we have now with the economic indicators. What I think is we're probably at a level where, yeah, maybe we need to see a quarter point bump higher in the effective rate or the target rate by the Federal Reserve. But eventually, yeah, the Federal Reserve is going to have to lower rates if but maybe 2-3/4 percentage moves. We'll see how that plays out, but we don't have that information yet. For now, I don't see the Fed making any kind of moves. The stock market seems to not care at all. Keep moving forward. So if you have an economy where it's gaining jobs and consumers are spending money, that means businesses are getting revenue, which means businesses will be profitable, which means those stocks buy on the dips. That's the bottom line right there. That with this report, if the Federal Reserve doesn't push interest rates higher and say, you know what, yeah, we're a little kind of wondering, we're just going to keep things here for right now, the stock market's probably going to keep going higher for now. The VIX, Volatility Index, spiked up a little bit yesterday. This is the one-day chart, and as you can see, we came down today. A lot of puts were kind of taken off the table. The put-call ratio, I'll pop that up here real quick. Put-call ratio moved a little lower, which means people closed out their put positions because the stock market was moving higher. They took the losses on those puts as stocks moved upward. So that was some insurance policies. With the retail sales yesterday, you can see the big spike up there. That's the red bar there. A lot of people rushed in and bought puts for protection, but nothing really materialized. By the end of the day, the number of puts went from 1.5 to below 1 slightly. Today, it's at 0.94 on a ratio basis, puts to calls. So that basically tells me that no one in the market is really that nervous, and I bet the put-call ratio kind of slithers downward a little more given the information we have right now. U.S. dollar index kind of moving sideways. There's a differential. The 10-year yield here in the United States is worth more than other countries. And so what will happen is individuals will sell those other countries and buy the U.S. dollar and gain that differential. It's upward as 4%. So there's money to be made. The gateway to that, the dollar. Spot gold bounced a little bit. If the economy is going to be moving forward, if there's no sort of fear that interest rates are going to be moving upward at this time, gold may start to trend a little bit higher. And I think this is kind of short term, that gold from this point, I think, kind of moves sideways, stays above the 2000 level, but moves sideways until we get more information. Bottom line though, bond yields will remain pressured slightly higher. I don't think the 10-year yield goes above 5% anytime soon, given the information we have. But I do believe that the 10-year remains above 4% for some time. The stock market doesn't seem to care because consumers are spending money. And if consumers are spending money, that's revenue for businesses, which means profits for businesses. Got to start looking at those charts again, saying, hey, listen, if the consumer's going for it, like they are, and there's more people getting employed, which will mean more expenditures because of more income, that means buy on the dip, find the undervalued stocks, start buying those, and this will push the S&P 500 upward. We did see all-time highs in the Dow, closing highs of the Dow and NASDAQ. I think the S&P 500 missed out on that, but I think we're probably going to take that out, and we might do so before the end of January. Make sure to hit the like and follow button if this is the kind of content you're looking for. Economics, how it applies to the stock market, and value investing. We'll see you in the next video.